Financial. Financial disclaimer. The information provided in this stream is for educational and informational purposes only and should not be considered as professional financial or investment advice. We are not licensed financial advisors, and the content presented here is based on our personal opinions and experiences. Investing in stocks and other financial instruments involves risk, including the potential loss of capital. Any investment decisions you make are solely your own responsibility, and you should conduct your own research and consult with a qualified financial professional before making any investment choices. The content we share on this stream may not be accurate, complete, or up to date. Market conditions and financial regulations can change rapidly, and we cannot guarantee the accuracy or reliability of the information presented. We do not endorse or promote any specific stocks, companies, or investment strategies. Any actions you take based on the content of this stream are at your own risk, and we will not be held liable for any losses or damages that may occur as a result. Always remember that past performance is not indicative of future results, and no investment is guaranteed to be profitable. Make informed decisions and consider your risk tolerance before investing any funds. By accessing and using this stream, you acknowledge and agree that we are not responsible for any investment decisions you make as a result of the content presented. You are encouraged to seek advice from qualified financial professionals for personalized guidance. Please invest responsibly and only with money you can afford to lose.
Hey man, just found the next guaranteed multi-bagger.
Hey man, you found another one? What is it this time?
Come check this out.
Okay, next please. How can I help you, young man?
We want to go all in on BON. We are all about natural life and we love all kinds of herbs.
Well, that's fantastic. A really smart decision, young man. We can put that check and it's gone.
Hey, how you doing, Johnny?
Yeah, I'm doing good. Been a bit of a weird week, but all in all, I think it's going well.
True. Yeah, I shouldn't have done anything this week.
Yeah.
Yeah, I made a few trades, nothing worked, so.
Yeah, I did 3, and I'm sure we're gonna talk more about them later. But I even did it because you have adjusted your watch, right, in the States.
What do you mean, like the clock time?
Yeah, you have 1 hour behind, right?
Yeah, daylight savings pushed us, so.
Yeah. So now instead of being most of the days I run home from work and I can check the opening at my computer at home, but now I have to do it at work. We're gonna do it for 1 more week, and we're gonna also adjust the time. But I actually had to do some trades at work, and I was like, I should not have done that.
Yeah, it's tough if you can't like sit and watch and do a good job.
Yeah,
But
I just had it, set it up in my head what was gonna move, and I saw they were moving up and down, and I just gambled, but I regret straight away. It actually held up that day, but I got stopped out the next one, so it's just annoying.
yeah, my thing is what I was looking for, and you know, I've seen this chart a million times, so I should have assumed it probably wouldn't just strength come right back. But as you can see here, you know, we had this up day on Friday, and then Monday showed pretty good strength, especially in the morning. It was pushing, and it got up to like that top Bollinger Band there, and then you know the next day it collapsed back down. So on Monday I took I think 3 trades, um, and they all looked good, and then they all got stopped out. And you know, I took like 1 or 2 other trades through the week, and nothing worked out. So this is a good example of just you're statistically, when you're doing this kind of style, you're supposed to be in a market where statistically, if you follow breakouts and you follow good volume, and you know, you focus on paths of resistance, that you should be able to outperform based on the statistic advantage of knowing that these stocks tend to move upwards. And in this kind of bearish market, you just realize that it's just not going to work. It doesn't work here. There's just, the odds are against you. So this is a bad time to gamble. This is no different than playing blackjack and the count's against you and you're trying to bet big. Like, you shouldn't be doing it. And don't get me wrong, I'm still betting smaller amounts in terms of like my trading size. But it just goes to show you that until you start to see some actual strength here, that you should just be still on pause. Now, don't get me wrong, this makes me feel like we're on watch, because I mean, you can see we definitely are moving sideways. It's been a pretty, you know, starting to consolidate here, and you're actually seeing some resistance in terms of, or support, I should say. But yeah, I guess during this past I don't know, month, my reflection from this would be that during these times, it's best to just stop doing anything.
Yeah, just completely stop.
Because don't get me wrong, there's names you could have gotten into, and if you were just really good at picking these, which I find hard to believe, you could have outperformed during this. Honestly, the way to do this is to short during this time. That's the only thing I see. You look for breakdowns, not breakups or breakouts.
I agree.
But
And
sorry, you go.
yeah, I think we talked a little bit about this last weekend, right? Where we both of us did very few trades, and I also did my trades this week on Monday, and then got stopped out on one straight away, and the other 2 the day after, because Monday looked like a good day, and then it's just like, and you know, I took those trades understanding that I might get stopped out very quickly, because I need more proof that things are turning around. Like you say, now it seems to be a bit flat and in like a waiting mode. And you know, we talk a lot about how you should shut out you know, noise from the market with news and people who say this and that. But when you sit down and do a lot of you know, watching and research like we have done, you also do the same of people you should listen to. And a couple of the ones that we like to listen to, they are saying like a little bit the same, that maybe they are a little bit optimistic that things are about to turn around, but that can still take time, right?
Yeah, no, for sure. And like I said, you know, I'm just trying to base things on like probabilities and stuff, because I find that's really the way that you successfully swing trade. Is it's all about just hedging all the odds and probabilities into your favor. And you know, you were talking about quantum right before the stream and stuff, and yeah, there was names you could have caught, but the problem is for every one of those names that you catch, it's hard to justify that the other 2 or 3 that look just as good don't break down. And you know, some of the quantum names, yeah, they're up 20%, but then the following day they're down 20%. So once again, I stick by my only correlation I've seen here is in terms of where I would normally invest here. I see like a day trade style. Like, you get in the morning, you hold it, and you sell out by end of day. That's the only thing I've seen that's been relatively successful. And even that, it's still tough. I haven't done it yet. I've tried to think of some ways of doing it, but I just haven't worried about it just yet because I just don't like the risk return for them. Even though I see some names go up, I also see a lot of them break down too. So it's tough to even justify doing a 1-day trade because if I'm setting my risk, for instance, at 2% and I'm only going to get 2% by the end of the day, I don't like doing a 50-50, chance that I'm going to make money. I guess if you were to catch a few of the big movers, maybe you could prove that, statistically in this environment, if you just had day traded it, and I'm not talking day trade like follow intraday charts and get in and out of things. I'm saying like hold till end of day, assuming that you're still looking at trades that normally in a solid market would be good swing trades. It's the same kind of stocks I'm looking at. I'm not saying I'm just getting on something that's up 100% and hopping in because it looks like the chart's going up and I'm trying to, skim somewhere in there. I'm not doing that form of day trading.
Yeah.
Still looking at the same kind of stocks that show all the things I would if we were swing trading normally. It's just my holding period would be shortened.
Yeah.
But I find I probably should best just be sitting on my hands right now and waiting till we get some
Yeah.
signals.
I was about to say, for me personally, I totally agree. I would also see, and if I did day trade on that one stock I took on Monday, I would be up like 9% on it or something, and then instead I'm losing. It even skipped over my stop, so I lost more than 3% on that one. So it just ended up being bad. So I totally agree that the day trading, and we have talked about this before, that that is a possible strategy in this kind of environment, but it's still risky. And for me personally, when I'm trying to grow my account, and people who have followed the streams know that I lost a bit on ALTO and also BNED, so I'm trying to grow back my account a bit here. So I think I'm just gonna skip doing anything in this environment until I have some room to play with again, I think.
Yeah, no, I agree. I think that's the right move. And like I said, really, ideally, you'd short and you look for breakdowns here.
Yeah, remember I told you about that guy who was up like 60% year to date, and then I was like, how did he do this? Yeah, he shorted everything.
I will say, I mean, just looking at here, if you look, the volume over the past week really kind of trickled down. And then Friday was a pretty good day volume wise, and we ended the day up. So, I mean, that looks good. I don't know. It's just, who knows how long this is going to go on for. In terms of this just being an overall correction, I mean, we're just around 10% down, just over it. That's a pretty normal correction that happens yearly, basically, on average, every year. You get a 10% correction. Every 3 years, there's a bigger correction than that, typically. So, yes, it could go down a little bit more. We could see a 15% correction. That's pretty common every 3 years. Much more than that's pretty rare. You don't really see much bigger corrections than that. Usually it's something like totally market related or worldwide macro related that you see something bigger than that, like the Great Financial Crisis or something like that.
Yeah.
And I mean, you can argue that all the trade policy in the world right now, because it's all kind of everything's changing so fast and there's so much going on. But I also don't think that's like, I don't think anything's so detrimental right now that it would actually really cause issues in the markets.
Yeah, I agree. It's just there's some noise and things need to settle down a bit, and information needs to be interpreted, and that's probably why it's down and moving sideways a bit now, hopefully. But I agree with you. We can go lower, of course we can. But I'm keeping. Remember, I told you about this book I was reading in Livermore that said about this guy. I don't know if it was a true story or just like a picture of how you should handle things like this. But a guy living in the woods who were very successful in the markets, and he just disappeared into the woods in these periods and came back when he got solid proof over a little bit of a longer term time. He came back and he did very, very well. So I think that it just sticks in my head, that story, and that's I'm right now I'm deep in the woods.
Yeah, no, and I agree with that sentiment. I just switched over now that you bring it up to a weekly chart because obviously I think this probably puts into perspective things a little bit more. And you can see here now we have had 2 weeks where we've kind of just held, which is good. I mean that's what you'd want to see. So well, I don't know. We'll see where it goes from here. I tend to think if anything, worst case scenario here is it's going to kind of bounce around right here. I don't see it going down too much further. I just don't see any reason number wise for it to go down too much further. But
No, and I
who
mean,
knows? I mean, I'm not saying I know anything. I could be dead wrong. Tomorrow it could drop, or on Monday it's probably going to drop 30% now that I said that. So
yeah. But there have been some. We don't usually comment too much on the bigger picture, but there are some news that are slightly positive, or like we are waiting on something slightly positive. So there are some catalysts I can see in the horizon that can turn things around a bit. But until they happen, it's going to be a bit quiet there, I think, from the laughing stock.
Yeah, and it's like I said, it's always going to be reflection and stuff. I mean, that's the whole point of the stream is, and yeah, there's going to be downtimes in markets where it's just even if you were doing deep value or anything, you're just kind of hanging out. I mean, that was the thing with deep value is, I mean, you were just kind of chilling, looking at stuff all the time, anyways. So it's really not too much different.
No.
And I did want to say, I know I can't remember his full name, but Tech in the Discord had asked us to go over the deleveraging calculator, so I was going to do that today. Just because it is complicated in terms of like when you first see it, like trying to figure out how you would make that work.
It's very complicated, but it's so important for the sheet if you want to use it in the way Ron Kitty did.
Yes. And I will say it's still always a general guideline. It's not like those numbers are solid in any way. It just kind of it's just kind of to make you appreciate the type of leverage a company's dealing with in order for you to decide when something is cheap, like how low does it need to go before you're comfortable investing in something that risky. And also the bigger thing now in hindsight looking back, the more leveraged, the smaller my position size would probably be. If something's really heavy leveraged, even if I like the story, taking like a 1% position or a 0.5% position probably is the right way to play that. Because sure, let's say it comes back and you're right and you nail it and it's like a 5-bagger. Well, you should just appreciate the fact that you took a 1% risk and you made 5% on it, of the portfolio. That's the way, that you'd want to run on it, because if you're wrong, which there's a good chance you are on something that leveraged, those companies, they get into trouble. They think they can run on this leverage, and you run into something that happened recently, like an interest rate rise, which, everyone had been so comfortable, especially in the States for, 10 years, we hadn't had interest rates go up. And then COVID happened and interest rates, they plummeted for a second and then they skyrocketed. So it's just one of those things that like, you can't anticipate. And if you just assume you're going to be able to run super levered, just be careful, because, that's why Buffett says, it's when the water goes out, you see who's still wearing their swimming trunks. Yeah. So, just something to think about. But that's to Johnny's point. That's why the deleveraging calculator is important. It's not just the numbers, that part's big, but it's also just understanding the kind of leverage that you're dealing with in a company. And once you look at a bunch of them, then you'll start to realize like, okay, this one's really levered, or this one's only slightly, this one's pretty safe. It just kind of like starts to put things in perspective for you.
And remember, we always went through the actual filings and the SEC sites to see, because they list the debt together with a lot of things, right? So it's important to understand what is, to separate things, and then also to look at the assets, the cash flows, and things. If they can handle it, then in the end you hope that they can manage the debt in some way, and then you will see the stock price come. So
yeah. And now just because I'm curious, I want to see the monthly.
It's not too bad when you do it like that.
That's what I always say. Every time someone's like, oh my gosh, it's terrible right now, I'm just like, just zoom out.
Yeah.
Just zoom out. I mean, this is a 5-year. Let's go to a 15-year. Oh, wow, it's so terrible. Yeah. Like, it just makes it seem so pointless.
Yeah.
Even 22 to 23, which was a rough period. This is a really rough year.
But you didn't hear so much then.
I know, that's what I'm saying. 22 to 23, we were like, it was nonstop bearish all year. It just could not catch. And then finally, at the end of the year, it started to just hold. And it still took months. But yeah, you didn't hear anything. That's why I say, like, you can only appreciate stuff so much because the news, especially now, it's just like it can try and push a narrative so hard that like it can start to deceive you because you just hear it constantly.
Yeah.
And the one thing I'll always say, and this is why I think it's hysterical, is when the markets are doing whatever they're doing and no one's paying attention, it's so hard to predict what the markets are going to do and what's good and bad. And when the regular news starts telling you what the markets are going to do, that's when I know it's bullshit because they don't know anything at all. Why would I start trusting them, during anything, especially on markets? If they're so smart, they should be all billionaires because they could have invested during this and killed it.
But then is it them or us that are stupid? Because imagine getting paid for knowing nothing.
Well, news reporters. I give them a break because their job is just to report. It's not like they're not making their opinions like they're just given a cue card and they say read this. It's a teleprompter and they just read.
Yeah.
So I don't care about newscasters. They don't have any like action. Even the ones who sit on panels and have opinions, like they're handed cards and they say this is kind of what's going on. Push these points. You know what I mean? Like they're they're just doing their job. I don't judge them. If you go on like a piece that's like more opinionated, like if you're watching a show and it's someone's true opinion that they're giving, then you can be somewhat critical of what their points are and whether you think they're right or wrong. But just the general news, I don't worry about that. They're just reading what they're supposed to read every day, and that's their job.
Yeah.
So it's fine. I don't judge anybody. Everybody, whatever your job is, I assume most people are doing a good job and trying their best. I've always had that kind of opinion of people. I think, we all get downtrended in thinking that everyone's just trying to take advantage of things. And I don't think that's really all that true. There is people out there, don't get me wrong. But I think in general, the average person's trying to do their best. They're trying to do a good job on things. They work hard.
Yeah. No, that's true.
I think that's nonsense to assume everybody's out there to just take advantage of the system.
Yeah. But we need more Ron Burgundies, I think.
Ron Burgundy, strong character. What we need? We need Hollywood to start making comedies again.
Yeah, there's so many. By the way, I was at the cinema 1 week ago. I watched a movie called William Tell. It's a new movie now on cinema. And that guy's name? It was in Switzerland. His name was Wilhelm, but in the cinema movie they call it William Tell. I thought it was gonna be good, but oh my god, it's one of the worst movies I've ever seen in my life. I think.
I didn't see or hear much about it, so I don't know. No. Yeah, that's disappointing too when you go to the movies and like the movie just sucks.
Yeah, it's been a while since last cinema I watched was Gladiator 2. I know people didn't like it so much, but I like that one. I'm a big Gladiator fan, but this William Tell movie was terrible.
Yeah, no, I saw Gladiator 2. I thought it was good. To be honest, having that much time go from the first movie to the second one, and it's an action movie, and yes, it's not going to have the same appeal that the first one had, because the first one was really a different movie for its time, and it was the first one that had done like that kind of arena combat on a big scale, well done. So yes, it's not going to be able to quite compete with being the new version, but I thought it was good, and I liked how it tied into the first one.
Yeah, I agree. I thought they did a good job separating them, but also tying them together.
Yeah.
Yeah.
What's his name? Ridley Scott. That guy's a great director.
Oh yeah.
That guy's phenomenal.
But they need everything is now. It's been such a long time since I've been watching some really enjoyable movies. I like some serious, but it's fewer and fewer also, to be honest.
I'm a big fan of horror movies, and I feel like the horror movies, there's been some really good ones this past year. So
okay, yeah.
But other than that, to get back to this, point being, there's not much going on. Got stopped out of everything. If I pull up the dashboard, not much going on. Couple things red, couple stuff's bouncing around. I did all my screeners to check how things are moving, and things weren't moving much. There wasn't many names that were making new highs, or just kind of everything's just kind of holding steady.
Yeah.
I'm trying to watch
Bitcoin
volume.
seem to establish itself between 80 and 85 now.
Mm-hmm.
So seems to be in that range for a while.
One thing, what's going on? Let's do new highs, new lows real quick, just so I can see. Yeah, see, still
Still down
kind of
there, yeah.
just staying bearish. You know, once again, this I actually liked. You know, you and I, we had went through some of these offset ones that RK had thrown into his risk column, and it does give you a good idea. Like during these periods, this is a good period to be swing trading. This is, you know, and these, no, bad time. So, you know, I should have looked at this actually, because this still said not to swing trade yet. You know, when we start seeing things pull up and they're pushing up, that's when you see breakouts occur. This is a good chart. Anybody who's wondering this, I'm not saying to invest on this or anything. As always, it's not financial advice, but I always like looking at this.
Yeah.
And that's the New York State Stock Exchange highs and lows. Was it the NASDAQ ad line? This is another one that I feel like gave you a good idea that we're just kind of treading downwards. And the whole point of showing you my portfolio is that I don't have one, or I'm not invested.
No,
So,
I'm also on, except my long term. Like I'm still in SSRM and Mastercraft,
Gotcha.
but the rest I'm empty on. I'm just cash.
Yeah, I've been kind of. I'm still watching USEG because now I think it's kind of found a base around. I would like to start getting in under like $1.30 because I've seen it drop into the 20s. And every time it seems to drop that low, it comes up. So I might take a position down there and start to slowly build again.
Around 130.
Yeah, if I could get under 130, I'd like to start to build a position there. It kind of bounces like over the past week. I watched it. It got up to almost like I think it was around like $1.50, but now I think it closed. I don't remember exactly where it closed.
It's at 137.
Oh yeah, 130. Well, you know what? Actually, let's just pull up in here.
And it's just below the 10-day.
Just to zoom in here a little bit. So yeah, see, it's gotten down to like $1.25. So if I could get sub 130, I think that shows pretty good strength. I mean, sure, could it keep going down here as everyone kind of waits to see if it can actually pivot into you know, helium? I understand that, but I think it's going to be hard to, because until we get news, which I think in June is the next time we'll get some news, and then probably towards the end of the year we'll be able to kind of appreciate how the transition's going.
Yeah,
it's going to be kind of a slow burn, but I still like it here.
Yeah, I agree. I also watch it every day now. I haven't taken a position, but I agree with you around here and maybe up to, let's say, 160. Then if you can get an entry there when it starts to turn around, I think you might be happy in the end.
Yeah. And then portfolio wise, the week I was down 0.5%. So that means last month I've been down 1%. Year to date I'm still up 2.5. So nothing great, but I'm not negative. The S&P and all that's still negative. So I'll take that. And this total percent gain, this is from October of last year. I'm at 25%. So I don't,
which is good.
What is the S&P if you add up the last 2 years? Or since October, I should say. Well, even if you had taken into account all of 2024, and then you take into account this year, it's up, what is that, 21 and about 0.5%. So I've beaten that number in half the time.
Yeah.
Although now, I mean, we're almost in 4 months into this year. So this year's just kind of been
it's been a bad year so far.
Yeah, the first few months. But I mean, you can't just expect every year everything to go up, you know, 15%. You know?
No, like you saw on the graph, and when you zoomed out also, it's like it's nothing to worry about. It's just a waiting modus. But like I said, the last couple of streams, I think when things start to turn and we see the breakouts, I need to show to myself that I deliver on the swing trading stuff, and that's I'm very I'm very keen to see how that goes. To be honest, I'm ready to sit and start to buy things again. You know.
Yeah, I just pulled this out, and I know this looks like really wild, but this is just 3 years, and it just gives you an idea of like how good last year was.
Yeah.
I mean, just really showed some strength here, and then like this is 2022. Look at how bearish this was at times.
Yeah.
And like I said, this is just new highs, new lows, so it's just letting you appreciate, but. Like I said, this really does go to show you that you could do swing trading in the exact opposite breakdowns on some of these periods.
Yeah.
And also to put in perspective, I mean, look at how small some of these
They are
downs
very
are.
small.
Yeah, comparatively to some of the past we've had. So not really that big of a correction so far.
No. No, I think for deep value stuff, you would look for things to buy here.
I don't even remember what the McClellan oscillator is. What the hell is this again? I don't know. It's all over the place. I'm sure. You know what I did actually, because I remember I wouldn't remember these, is I left a link.
Oh yeah.
There's been a number of advancing and declining issues on a stock exchange. Okay, so it's just another way of looking at it. It's okay. So, but this one's kind of dumb because this is literally going to track what the S&P is doing. Like if the if the Nasdaq's up or the S&P doesn't matter, this is going to be up. So this is kind of the same thing. So I don't really care about this one.
Yeah.
Like that's not as useful in my mind when I'm looking at things. And what was the other? Oh, the call ratio. That's another one that's interesting. Nah, just slightly bearish.
Yeah.
But still, not even it doesn't like swing in one direction that makes me think like, okay, we know at this point, things are looking better or things are looking down, which is like I said, I like to look at this stuff because it puts it into perspective when you're trying to figure out where the markets are at. If you continually check these things in good times and bad times, it will help you appreciate kind of where we're at. And then every time you look at it, you start to you just start to be able to follow it better. One thing I didn't check is how are insiders doing right now. Let me just update this real quick. There's still a lot of insider buying, so I mean, it just lets you know that
There was a purchase in the USEG also 13th of March again from the CEO.
Good to know. What price was that at?
132.
Nice.
Another 1,000 shares he bought.
This guy's just always pumping thousands of shares.
Yeah. And I saw just while we wait a bit here, I saw in ALTO the two board members have withdrawn, and they also made like a deal with two of the activists that has filed a letter against them. Basically that they're gonna chill out for a bit. At least that's how I read it.
Yeah, I remember I saw you guys post that the stock price had been kind of getting beat down.
Yeah, well, I think it went down to 120. But to be honest, I don't know what to say about that they exit the board, those two people, because I think that was, yeah, I don't know how meaningful that is. Like we said last time we checked ALTO, I think you will have time to jump in when things actually start to turn and you have some solid proof. For example, if someone takes over in the board seats or something like that, I don't think the share price will skyrocket up to 6 straight away,
With that much volume being taken, do you think this has anything to do with Justin?
I mean, don't see the chart.
That's a lot of volume.
That's a lot of volume, yeah.
4 million?
Yeah, I mean, he owns 7. I'm sure he would like to get to 10.
I'm just saying that hasn't been done only a few times over the past few years. That's a lot of volume.
That was a lot of volume. And that day it opened at 122, which is, you know, where it went to when after last report that sucked so much.
I mean, I'm not, you know, excluding COVID time periods when everyone was buying like crazy. In 2022, there was 1 day, 2 days, a few in 2023. It looks like kind of when there was that initial pump that you and I got in on. And not that it's a pump and dump. I'm saying like it was a pump because, you know, it seemed like the company was possibly heading in a good direction. And then they just destroyed everybody with their terrible numbers. But either way.
Yeah, I'm no position now. I'm checking it occasionally, but I have to say I'm a bit out of the last updates and stuff like that. We went through it. We know that Justin is a big owner now. He has always been a big owner, but he went up to 7%. There has been 2 activist letters. Everyone agrees they could get $6 out of this company if there's a full sale. And now the thing starts to happen in the board. But what I was saying is like I'm not sure what that is connected to, because when one of them was the old CEO, which is an old man, and when he retired as a CEO and stepped into the board only, the way I read it at that time was that he's not going to be there so long, but you know, maybe he just wants to exit when he can, and I'm sure he has a good amount of money.
Yeah, I would imagine.
But yeah, that volume is high, but I don't know.
Yeah, I just what I'm doing and looking in here is just kind of getting a feel for where the markets are at, and I feel like it looks like people are kind of starting to acquire again here. I'm not making a call that like I said that things are back. I still think we need to wait a little bit longer for more of a clearer signal. Which, you know, things I'm looking for is like, you know, because I'm watching for breakouts, is like how many breakouts are occurring, how many are successful. If I see, you know, a bunch of them occurring that are successful for like maybe like a week, then I'll probably really start considering. Because I think this next week I'm just gonna sit tight and just wait. Even if I see breakouts, I'm not gonna take them just yet, just because, like I said, odds are against you.
Yeah.
Just to switch lenses here and to get over to the deleverage calculator.
Yeah.
All right, so Johnny and I had pulled up on Big 5 Sporting Goods just because this is a good one that shows the leverage calculator. And this is an interesting company because it had some solid years and now it's kind of struggling, as you can see with my pretty colors. So, Tech, if you have any further questions when we're going through this, just let me know. But once again, remember there's 2 major parts to the, well, I should say 3 major parts to the deleveraging calculator that make it worth your while. Now, I've added a bunch of things that Arcade didn't have just for my own thought process and, you know, in trying to determine numbers. But like the values I have on here, prices and things like that, you can pretty much ignore them because they're just me looking at things in different ways. It's not like these values are worth anything. It's just ideas of how things are. But there's, like I said, there's 3 main sections. And the first section is up top here. And this is just using a bunch of regular calculations to kind of determine how levered or safe a company is. There's the actual deleveraging, which basically what this does is adjusts share count. And that's based on percentages of what you would want the company to perform at. So I can either set this at keep the current share count, which basically assumes that the company is safe and not highly levered. So I shouldn't need to delever things in order to make the company appreciable to other companies that aren't levered. And then the other 2 are comparing my average cash flow compared to net common overhang. And how RK defines net common overhang, which I looked this up a lot. It was tough to really find his version of net common overhang, but what he's really just saying is if you look at assets minus your liabilities, like how much money is actually there. If you look at that compared to cash flow, how is that? So the idea being here that this company right now, for instance, has poor cash flow, like it's negative 50 cents. So this is going to be high because it's going to be saying an average is -4. So it's saying, hey, in order for this company to survive, they're going to have to delever pretty heavily in order to start making money. Basically to offset the fact that they're burning cash. So it depends on when you look at a company, when you're trying to discern, should I use net cash flow or should I use assets compared to common overhang? Assets are maybe the company's making money, and but they're really levered. So this is a good one to use in that case because if they're making cash flow, then that's not the issue. The issue is that they're just not structured properly. They have too much debt taken on, basically. And maybe it's just because they have to. Maybe that's part of the business, but that's up for you to figure out when you're reading into these things. I tend to use the assets to net common overhang more than I use cash flow because you can have a few bad years of cash flow, like if it's a cyclical company, and that's going to make it seem like you should really delever something when you probably shouldn't because it's going to come into years of strong cash flow versus not. So, and then the third part of this is you adjust your metrics. So for instance, like my first column here, like this is earnings per share, or let's go to like cash flow. You'll see on some of these over here, like my first cash flow one on this side is not adjusted, but then you'll see these ones say adjusted. And what that means is I take these numbers and I adjust them. And I know, sorry, these equations are nuts. You can look at these, or if you have more questions on the equations and stuff like that. But it's a mess. There's a lot going on in the background. But basically, what I do is if I want to adjust how these numbers look, right now I'm on net common overhang for assets, which basically tells me that I need to increase my share count to 181 million to offset the debt that they have. And real quickly, if we go over to our 1 year data, just to give you an idea, they have excess cash of -3 million right now, and they have in total debt $300 million. So this company is very levered, and the idea here is when you're trying to look for deep value on these kind of things, and you're trying to decide, can this company survive, which was really RK's big point. This lets you know, if you believe in a story like a turnaround, like for instance, let's just use GameStop because that was an easy one that RK was using. If they have a clean balance sheet, and when I say clean balance sheet, and I want to break this down into kind of layman terms, because if you're someone who doesn't really understand the financial side, I don't want to talk over your head. What a clean balance sheet simply means is that a company has more cash and assets on hand than they do liabilities and debt. Okay, you're just when you're comparing both sides, a good looking balance sheet is one that has assets, they're making cash, versus one that, or not even necessarily making cash, but they're not paying into debt that they can't afford, essentially. So to break it down even dumber, if you have a credit card and you can't pay your credit card debt, that's a problem. That would be a bad balance sheet for a company. So we're looking at that. So right now, this is bad. This is not good. You don't want to be $300 million in debt and be making -$3 million. That's not good. That's a bad idea. So what my thing is going to do here is going to say, hey, if that's the case, that's why this cash flow one is so insane. It's saying you need to delever this by over 10 times. And that's just to get it at 20% of the net common overhang. That's what these percentages are. So you can change these too. I can change this to any number I want. I'm not going to go too crazy. And 20% is pretty safe. Usually you want your cash flow to be about 1/5 of your net common overhang. That's a good position to be in. I'm not saying you have to get there, but that's a good position. But you'll see here that, like, if I look at my numbers here, let's see, total cash flow is 45 cents, 20 cents, and then -4. Oh, hold on here. I gotta, my mouse is off from where I'm actually at. So if I change this to a 1, it's going to recalculate this all based on that number. and then you'll see my cash flow dropped hard. And what this is saying is now it's saying that in order to get the share count here, if I dilute the shares to 457 million, what it's going to do to my cash flow is dilute it now down so it's even. So let's just real quick, we'll go to 0. So this is total share count. This is nothing adjusted. So when we look down here at my cash flow average, I get per share in what is this, 2022. And let me know, guys, if my picture's blocking or anything like that. I don't know if anybody's in the comments here to judge. Or Johnny, call me out if I'm blocking my screen here.
Yeah, I didn't check it, but I think you're good.
Okay, so like it's saying, 2022, it was $3.54 per share. Now it's $1, or last year was $1.57, and then this year it's minus 31. And this is a problem with this calculator because you're going to notice it doesn't adjust. It makes the negative look better. It doesn't make it look worse. It makes it look better. So it's not perfect because, but I mean, the ideal would be that you dilute. So even with negative money coming in, it would be less per share, but that's still not a good thing. So just keep that in mind if that makes sense. Like remember, like as you take a negative number down, like I actually would want this to increase my negative number, not bring it to closer to 0. So at 23 million shares, it's making $3.54 per share. I mean, that looks good. But the problem is it's so levered that if we were to actually make this a financially stable company by increasing the share count, which would bring in money to the company, it would take it from that down to really what you made was only 18 cents per share. So it lets you know that when a company's really levered like this, even really good share counts or even really good cash flow from operations per share, it's not as good as it looks because they don't have enough money to continue in that vein because they have to dilute shareholders, either that or take on debt. They can't take on debt because they have no money and no bank's going to come in here and look at this company and be like, oh, you guys are losing money and you're $300 million in debt. Let's give you more money. Like no one's going to do that. So it lets you know that like this company's in a serious financial crisis right now. Like without them really pivoting their model or doing something to handle the debt, this is going to go bankrupt at some point. Now the question is here, how much time do we have till bankruptcy? And how much, what is their optionality in terms of getting out of bankruptcy? Now that's a whole different loophole, and I just want to focus on the deleveraging calculator, but that's how you should be thinking of this. So what am I doing here? So initially, in order to determine if something is safe or levered, I do a quick valuation here. Oh God, I don't want to go too crazy into this because you see all these calculations in the background making this all work. But basically, to just make this simple, and tech, I can go into some of these more specifically. Z-score, which is just a calculation based on, you can look up what a Z double prime score calculation is. But I'm just saying, hey, if the number's less than or equal to 1, I want this number to be a 1 in this column, AB. If it's greater than or equal to 1.1 to 1.8, make it 2, blah, blah, blah. Otherwise, make it 3. And if it's better than that, make it 4. Higher the number, the better the signal is. And as in terms of like, if this Z-score number is a 4, it means it's a safe company. If the Z-score is a 1, it means it's highly levered and it's probably not financially stable. So if you see all bad numbers in here in my calculation, that means most likely this, which is determined by, I believe if the number is greater than 10, it's 8 or 10, it'll tell me it's levered versus safe.
Yeah.
Just trying to figure out where I actually have it.
I think it's.
Yes.
If it's
okay.
above.
No, I'm just saying in my calculation. So if these numbers add up, and I'm not talking, and it's only 7 through 9. So I only take into consideration these first 3. So I only take into Z-score, cash flow from operations compared to net common overhang, and then net common overhang divided by assets. I take into those 3. If these numbers right there add up to 10 or more, I consider the company safe, and I don't take into account any kind of leveraging scheme. I can, basically what it's telling you is, hey, you can look at these numbers and you can take them relatively accurately. And how that helps in valuation is, let's say a cash flow from a company is $1 per year, and let's say they had 10 million shares. Well, that's pretty good. I mean, that means if you own a share, you're getting about $1 in cash flow on that share. Now, this is 2 operations. So it doesn't mean that the company actually like gets that dollar and can hand it to you, but it gives you a good idea that the company's doing really well and that they are generating cash flow. And then, you know, it goes up from there. If the company's, let's say they had $5 in cash flow, you know, how consistent is that? Is it cyclical, or is it a one-off? Is it something that they're constantly doing? And just real quick, just to give you a comparison, I'll pull up a really uncontroversial company to look at. And I'll show you what good numbers look like. Just a second, it's just going to load in. And sorry, just because I'm braided with Tesla is why I'm going to use it. I do not own a position in Tesla. I have no feelings and or towards the company or whatever. But either way.
I saw there was some talk about the Cybertruck now.
Yeah, about what? What are you saying?
That it was just glued together with different parts.
Yeah, I did see there was a recall or something.
Yeah.
But yeah, I don't really follow Tesla all that closely, so I really don't know. I'm just saying I can tell you right now when I pull these numbers up, which someday it will load. There it goes.
Yeah.
You'll see. Okay, so Tesla, number one, if you look at its numbers, it's very safe. 444. You know, it has 200% cash flow compared to common. Its net common overhang or its debt is only 6% of its assets. And its Z-score is very, very high, 14.5. So it clearly clears a Z-score calculation. So what it tells me is this company's safe. You'll notice it doesn't change anything down here. It won't offer shares in any way because it doesn't have to. So these numbers will never change. They'll always stay accurate. And once again, cash flow from operations, you can see, is about $4.65 per share. Same actually on a 3-year average, and on a 7-year average, it's been increasing. And the longer you look back, the more of a trend you want to see something increasing, not decreasing. It's not like $2.89 really matters because it's a 7-year average, but it should let you know that, hey, this number's getting better, not worse. So Tesla's continuing to do better and better each year. You know, I mean, the numbers are just crazy here. It basically has very little debt. It has increased its debt. It was cash flow positive for a second, but also it did lose a ton of money in terms of its share price. If this price goes back up, it will totally change these numbers even better because the company has even more cash on hand, which makes it even less of a liability, which is better for shareholders. Does it need that cash? No, but it would just look even better as the price goes up. So it has 3 million shares though, so that's something to take into account, or 3 billion shares, so something to take into account. But even with 3 billion shares, it still generates $4.65 in cash flow from operations per share. All my numbers are based on 12 trailing months of information. So you may get a different number when you calculate it. And also mine's only as updated as Share Radar data is. And I know this is a million things I'm going through. So sorry, if you do have questions, just let me know. But just to give you an idea, so once again, that's why this matters, because when I'm looking through here and I'm trying to make a judgment call on cash flow here, this is the way to do it. This is the way to determine how good things are looking or how bad things are looking. And then in terms of, you know, me calculating what this thing's worth, sure, I could argue it's worth around 240, which is actually where the price is, and that's probably more of a historical value type price around these prices. And especially as it gets below that, I would start to argue that Tesla starts to become a value if it continues to grow in the way it grows. Now, if you're strictly a growth investor, these numbers are all going to look low because growth investors are going to be projecting this out based on previous numbers. And if Tesla continues to grow at any of these numbers, it could be worth way more than this in 5 to 10 years. That's how they're looking at things, is projected 5 to 10 years. Value investors typically look back and we say, hey, you know what? It's consistently grown at 50%. If we just can assume it will grow at 50%, or even a little bit less than that, like take a conservative number and say it grows at, you know, 50% next year, 40% the following, 30%, 20%, because it continues as you get so big, it's hard to keep those growth numbers up. And I guess growth investors are doing the same thing. But my point being is, when you look at something like this puts into perspective a company like Big Five. in terms of how levered this is compared to Tesla. So let me pull this back up. And once again, I'm not saying Tesla's going to continue to grow. No comments on anything. I don't really care. But around there is where you can start to decide how much value do you want out of something? How cheap do you want it to be compared to whatever numbers you develop? Because to be honest, like I said, all my calculations here are based on 52-week highs and lows and cash flow, assets over the next so many years. And I just kind of get some general calculations based off that. But one thing I'll do, Tech, is once this loads, is just to show you. So it's kind of a pain because you're going to see I can't really show you the calculations on this side because it's mixed into my thing. So if just to go over to my 1 year real quick, when I'm looking at net common overhang, I'm calculating it from these numbers, which are, it's here. I'll just leave it here for a second so you guys can see it if you need. And I'll scroll over one so you can pause the video and stuff if you're trying to do these calculations yourself. And you can see kind of how I do it based on what my numbers are and what where I'm pulling that information from. Assets, I just get that from Share Radar data, how much the assets are worth. Excess cash, that's also just that's just a data point I have on how much cash is on hand on the company. You can quickly pull up, like a 10Q or 10K and get some of these numbers. You could go on something like, Yahoo Finance, but the only problem is they only give you like 1 or 2 years of data. So it's not much to go off of, which is why you can use Y sheets, any of these things to pull in your information, data, whatever you're using. And I know, I think he said he's using Python.
Just on the excess cash formula there, I saw you also calculate 1% from the revenue. And I know Roaring Kitty said like 1 to 2%, because I had mine calculated 2% in the beginning, and I picked up that he actually used 1%. So that's just what he did. He probably changed it every now and then, I guess. But
yeah, and the idea, just to explain what we're talking about there, because I'm sure no one knows what the hell you're talking about. Our case simply just said when you have excess cash, like 1% of that cash, you just have to assume is going to pay off any kind of overhead, like little things all over the place. So you basically just subtract like 1% out of whatever their cash is, because it's just like you can't totally rely on their cash, because it's gonna some percent of it, and even though it's only 1%, is going towards all kinds of costs that are just inherent to business. It's a really crude way of explaining it, but just that's why that calculation's there. Just trying to show you some of my things so you can pause the video here, and if you want to see how I'm calculating something, you can see where my thing is comparatively. Cash flow from operations. This is just a data point. So I'll show you down here on my data. This is how Share Radar comes into me. I have all these numbers and I have them all aligned in a way and based on the year up top here. So when I pull stuff over, it just gives me these numbers. You can compare your numbers. I'll scroll slowly through this one time, just so you guys can try and compare numbers, just to see how wherever you pull in your information, how consistent it is with mine. Remember, it's trailing 12 months, so it might differ a little bit. It doesn't matter, because it's just the general scheme of what's going on here that matters. And I have some of my own calculations down here, stuff I find useful at times, but it doesn't matter in terms of this. So going back to the main column. Okay. So once again, I'll pull these ones up just to give you an idea of how I generally calculate these. Now, RK never specifically shows how he gets his 1 through 4 value to determine this in order to determine if something's levered. But if you start to understand what cash flow is and net overhang and Z-score, you should be able to come up with your own way of determining how close this is to what you agree with. You could play with these numbers all you want. It doesn't matter. I'm going to have an idea if it's levered or safe. That's all I care about. And then down here, you're going to... Oh, God, these calculations are brutal. I'm sorry, guys. I haven't, and I could go through these and try and show you what's going on here. You're going to have to go back and forth. It's what I had to do to figure out our RKs, and you can see how tedious this can get. But basically what it's saying is, hey, take in some of these numbers here. I want you to apply if the share count was adjusted to like 457 verse 23. I want you to adjust these numbers and show me them over here, okay? So that's kind of what's going on here. That's why these numbers are different than what the actual numbers show. Like this is saying that, you know, book value per share is 774 based on if there was 23 million shares outstanding. But I'm saying, hey, but if you diluted it to 457, book value per share would be about $1.14. And this is where the real crux of the whole point of the deleveraging calculator helps you, because it helps you adjust your numbers here to make sure that you have a more accurate representation of what the share price could be. So for instance, you hear a lot of people say, oh, you know what you can do? You can see if it's under book value. And if it's under book value, it's probably a good deal. Well, that's true for a delevered or a company that's not levered. But if you have a levered company, you have to deleverage that number somehow to adjust it to try and make sense of that book value. So what I'm saying here is, hey, if I tried to get my cash flow to a percentage of my net common overhang, or I tried to get my assets to a certain amount of that overhang, if I do it by 20 or 30%, this would give me this many shares. If I have this many shares, and once again, I'm on number one, which is saying I'm using my cash flow number, I want you to take this 774 and whatever percent that is, which is 2011%, that's where this number comes from. Basically take 2011% of this and it makes it come down to $1.14. So I'm saying, hey, because this is so levered based on cash flow, what this actually should be worth book value wise is $1.14, not the $7.74. In other words, if you wanted to even get to this book value, the company would have to offer about 425 million shares just to break cash flow even wise to get a book value. And this is down to $1. And now why this matters, and in terms of putting it in the bigger perspective here, is let's say this company has, let's just for easy numbers, let's say they only have 1 year before they run out of cash. Let's say their debt is going to be due at the end of this year. You think of it like an options play, because options all have to do with the chance that it either goes one way or the other. It's just a statistic of trying to figure out if it goes one way or the other. So if this only had 1 year to survive and it's worth $1.14, every day this should technically go down by whatever, if there's 200 trading days in the year or 250 or whatever it is, you could divide 114 by 250 days, and in a perfect world, whatever that number is, this would go down by a penny or whatever it is, or half a cent every day until it runs out of money. Because essentially, if you're putting money into this, you're assuming it's going to go down to zero at some point, become bankrupt, shareholders would lose everything. Now, it's worth always a little bit more than that, because there's also the chance that they figure it out and they gain money on it, which means the share price shouldn't be actually down. So this being trading at $1, it's probably pretty reasonable. I don't know when their debt's actually due. You can look that up on the SEC. So just real quick, just to show you. Oh God, I haven't been on here in a minute. Interactive data. So you can go to interactive data from the 10K. Go to financial statements, or let's do notes to it. Long-term debt. Does it tell me when it's due? This goes the private financing group and maturity date of 26. Okay,
26.
So their stuff's due in 2026. So they have till February. So yeah, they have about a year. So you're going to see this continue to go down until they either figure it out, they restructure their debt, or they offer shares. That's really all you can do. Or someone buys them. I mean, those are like the few things that you got going for yourself. So, like I said, the bigger point here is to remember, like if you're going to invest in this, say you knew what the company's doing, and you listen to the CEO and he's like, hey, we're pivoting, we're going to sell off these parts to get rid of our debt. We're going to open a new line of credit, and we're working with creditors right now to get out of this position. You know, you're going to see basically this number fluctuate based on that news. And that's why the narrative comes into play. And it's not just based on the numbers. But just to show you behind the scenes what's actually going on in this calculator, because now I know you're like, okay, well, how do you calculate that number? There's a few things that go into these kind of calculations. And like I said, all I'm doing is adding this percentage to what the initial share price is to get these numbers. But to actually calculate it, it's kind of a pain. You have to do it one way or the other. So for net common overhang to assets, I'll just show you the equations here. And you can figure out how I come up to these numbers. You just take your common assets and you divide it by cash flow, and it's always a percentage here. So I can adjust this, which will adjust these numbers. I'll show you like it's an if statement. It always is saying, hey, if this is 0, ignore it, which is basically saying if it's a safe company, you don't have to do this calculation. And then I base that off of what the price is, and I give it like I think it's 8% of whatever that price is to try and adjust some of these numbers. And you'll see I come up with God, I can't even remember exactly what's going on in these calculations.
It's like a 20% discount, I think, that 0.8 is.
Oh, okay, it's a 20% discount.
Yeah.
Yes, and that's based on the share price. But what it's basically doing is it's saying, hey, I want you to get my common assets or my common overhang to 30% of my assets. In other words, most companies are considered safe if they can pay their debt off within 3 years. So what you're saying is, hey, I want you to delever this so that the company would basically be able to cover their debt over the next 3 years, or that their debt's only worth 3 years of the company's money. And that's just like general finance, where you come up with that number. So net common overhang, see the problem is it's negative, so it makes this really ugly in trying to calculate what the price should be. So this 433 gets added to the 23 million shares outstanding. That's how I come up with my number of 457 over here. So once again, I'll just kind of click on these things so you can see them once, see the equations. Which I'm assuming if you're in Python, you'll know how to make the same if and or statements in Python versus coding it in just like formulas in Excel. And there's the last one. And you'll see, that's the other thing, I have stuff hidden in all these spreadsheets to make this all run smoothly. But those are the calculations that are going on in the background. But you basically have to, you kind of have to find like a 0 point, and then you be able to adjust these numbers to make sure that you're actually making it 20 or 30% of whatever the number's supposed to be. And that's a long-winded way of showing you how the deleverage calculator works. And then once again, if you look at my columns here, anyone that says adjusted, it takes this share count or whatever number this is on. I can do, like I said, I could go to, if I wanted, and say I'm like, you know what, I don't really care about cash flow for these guys. I just want to see if they can get their debt levels to 1/3 of their assets. If I did that, it would change this to 181, which then adjusts everything. You can see it brings up the value of book value up to $1.66. It shows you it takes the leverage. Now, net common overhang per share. This is saying, like, I mean, if you go to this number, if we go to 0, oh yeah, it's going to put this at 13.55 because it's saying per share right now, if you buy a share of this, you have almost $14 of debt per share. That's how much debt this company has per share. So if you're a shareholder and you're buying this, when you buy a share, know you're already $14 in the hole buying this. Okay. Now they can turn that around. That's not permanent, but just know that's the kind of leverage you're going in here. If we were to adjust it though and get the assets down, if you were to offer 181 million shares, the cash that would raise, and oh, that's where the percentage came from. Because if you're going to sell that many shares, obviously you're going to tank the price. So you have to take off so much percent. And I think mine is like, it's heavy. Whatever I do for my calculation, it's like assuming that the stock price goes down 30% or something. Because if they're going to offer 180 million shares, the stock price will go down, like way, way, way down. So, and maybe that number is not even, it might even be 50%. I don't remember where did I put that number? Hold on, I'm just trying to see if I can find that number. I don't know. I don't remember where it is. It's in here somewhere. But basically, I'm saying that you have to not only sell shares to get 180 million shares, but you have to sell it at a huge discount to 99 cents because you can't come out with 180 million shares and not expect the stock price just to tank. So I think I shave off almost 50% and say the share price will go down about 50% if you offer that many shares to try and pay the debt off. But you'll at least put yourself in better financial standing. So sucks if you're a previous shareholder. Knock on wood, BNet. But basically that's how it works. And then that kind of gives you an idea when you're looking at these companies on where you're delevered. So
Yeah.
I don't know if there's anything else I should try and add to that.
And just to move further then in this case, and Roaring Kitty in GameStop, a big point of his was that the debt looks way higher than it actually is because a lot of it is leases, and that's where you need to go and read the report.
Yeah, you have to know what your debt is too, which is why I have this adjustable. It's why RK made it adjustable. Or it's why when you look at this, I can say, oh my God, they'd have to offer 457 million shares. Well, then if I go in there and I realize it's operating leases and that doesn't technically exist as true debt, I can adjust these numbers, or I can just totally exclude it and just say, you know what, they wouldn't have this. This isn't real. It's not. The company's not going to go bankrupt, because they could just sell off stores or something like that. And sure, that'll hurt them in certain ways, but it doesn't mean that the business is dead in the same time frame it would be. And like I said, there's maturities, there's lines of credit, there's all kinds of things that are due, and you can push these things out depending on the company and the standings. Can have other investors come in. And this is why RK said he held other people's, whether it be insider buying or whatever, so highly. Because, for instance, when he got in on this, now granted, he saw his own thing and started taking his position when he did. But when you see someone like Michael Burry come in and have a similar thesis that the company's not going bankrupt, that gave him all the confidence in the world to put that heavy optionality on there. Because when you see Michael Burry come in and say, hey, if I look at these numbers, GameStop can get out of this. All they have to do is X and X. It gives you an idea that the cash flow that's going to come into GameStop was all due on the fact that the consoles were coming out and they were going to generate more. And if you had just looked at the previous console cycle, it gave you an idea of how much cash flow it was going to generate. And if you add in that cash flow, that basically says you can eliminate this number because they are going to get cash flow. This number is not going to be representative truly of what it's going to be over the next 3 years based on those new consoles coming out at the time. It didn't actually work out like that. And, GameStop, it got lucky. It got Cohen to come in at the same time. There's a lot of things that just happened to land just all right for GameStop. But, anybody who says that the whole thing was a charade and, it's kind of BS that the company ended up being worth what it was, it was and wasn't, because at the same time, too, there's a lot of people who came in and saw the possible upside there. And that's what it takes, Something like BGFV, if I pull these numbers up, like let's say all I showed you is this column, this doesn't look good. So a lot of like investors and a lot of and the problem is even institutions, they look at this and they're like, no, don't invest here, But if you can go in and look behind the scenes and you can find some way, some thesis where this ends up working out for the company, and then you could do the math down here to see, what position size and what risk you should take into it, you can invest in these things. And just remember too, it has to do with the fact that, if this doesn't go bankrupt, people are counting on this to go bankrupt. This valuation here, this it's worth $1, and it's $1 in debt. $1.66 at book value based on common assets to overhang, or common overhang to assets. If this somehow survives, this could be worth a lot more because, like I said, let's say all of a sudden they get a 5-year runway. Well, if you get a 5-year runway and this is worth $1.66, this price could go up 50% from here because it could go back up to $1.66 based on that book value. And if you argued that right now it's worth $1.66 because they have a 5-year runway, I would argue you're correct based on, you know, and I'm talking about like, you know, Answath de Morton, the way he looks at it, and he's a valuation expert. I mean, he literally teaches it. You know, that's how you determine where something should land. And yes, the numbers aren't perfect, and that's why even RK said, like, you know, he stopped digging into these numbers so much. He stopped assigning values to these things because it doesn't really matter. You know, you're not going to sit there. The market doesn't give a shit if you calculate this, and you know, not everyone's doing it this way, so it doesn't matter. But just know, if you're a value investor and you're trying to somehow calculate how to find a value of something that this levered, this is one way to do it. And is it bulletproof? No. RK said that right away. So you can sit here and methodically go through and try and come up with perfect valuations. But the overall picture should be that when I look at this and I'm like, okay, if I was to heavily delever this thing, they're making like 35 cents a share. I can quickly calculate how much money that would raise, and I could see what the debt level is and see if they can get out of it. And if I don't think they can get out of it, it's probably one you just pass on. If I do see a way for them to get out of it, you know, if I look in and the CEO says we're going to sell 50% of our stores, which would pay off this much debt, and we're going to keep only the more profitable stores, which would raise this cash flow to like $1, you know, based because now you don't have all those stores that aren't doing as well. Maybe they can get out of it. You know what I mean? Something along those lines. And if you're confident in that, you could start to bump that position size up where maybe, you know, initially I'm like, oh, I'd only take like 0.5% here and just pray. You know, I'm just praying that somehow they make it out. Maybe with like a GameStop where RK took a 5% position. And granted, I'm assuming that RK never lied and his numbers were correct. If you looked at his deep value account on Reddit and you compare it to RK, the Roaring Kitty portfolio, if you did the math, it said at the time that he made the $50,000 investment in GameStop that he had about $800,000. Because if you look at the percent of his account, that's about what it was worth. Now, you can argue that it wasn't worth that all you want, but if you look at what his deep value account is and you just do the simple math of what he showed his percentage of his account was compared to all his other positions, it meant that at the time he had about $800,000 and 50% of it was in GameStop, whether it be options or shares. And that would be a 5% position about. So if that's true, that's how RK would handle something. So if he really believed in a thesis, you know, looking at deep value, we're looking at shit companies constantly, the biggest he went was 5%. And what that should have been is a huge red flag to me, because what I ended up doing is going really high percentages with some of these companies, trying to make big returns. And all it showed you is you really don't need to. Now, granted, a bigger risk to take on is he did it with options. So maybe if he only held shares, maybe he would go over 5% position size. Maybe he'd go to 10 or 15 if he was really confident in something. But you have to remember with options, if you're wrong, you lose all of it. So he's willing to risk 5% of his portfolio for exponential gains like he got with GameStop, with the knowing that he could lose up to 5% of his portfolio. So that is a long way of explaining that deleverage calculator. I hope me clicking on things could give you a better idea of my calculations so you can try and use those in Python. If you have questions, just shoot them in Discord. This ended up taking a while, so I think this is a good financial overview. If you have no idea what the hell's going on in finance, this is some of the basics.
Just from the calculator.
Yeah, just in that calculator to figure that out. And that just gives you the idea, like when people are like, hey, can I copy your spreadsheet and use it? And we're like, oh, you can, but like, you got to know what you're doing. And to be honest, the reason you can't is because this is linked to my share radar data. So if you don't have that, it wouldn't even work for you. And anytime there's an error, when there's an error in here and you're like, oh, I got to fix this calculation. Good luck. Good luck if you don't know what it's doing, because I don't even know what it's doing right now. I'd have to sit here and go through this and figure it out real quick. And then I could, you know, and I'm the one who came up with this. Once again, granted, it's based off someone else's, so it's not like I just totally came up with it. But in my idea, I understood what I'm doing here, and I can make this ridiculous calculation here, and it works like how I wanted it to. But just know that that's part of the reason it's tough to hand these sheets out. Like, you are not going to know how to fix if something's wrong. And it pulls in from different spreadsheets. You know, they're all interlocked. This data comes from other places. So, you know, like, you know, this is pulling in from my other spreadsheet. You know how complicated this gets? It's just nutty to build something like this. You know, either way, long story short, that's part of the reason it's so tough to ever consider handing this out to someone. I would have to rebuild it with the idea that it would be plug and play for someone else, as opposed to just something for my own utilization. I built this for me, not for everyone to be able to use. That's it. I would have to go through and edit a million things in here, and there's errors and stuff I know how to handle and deal with because of the way I built it, where I wouldn't want to give this to someone else because I know it would fail and they would quickly not know how to fix it.
Yeah.
And yeah, we didn't really do charts or anything today, so sorry if you guys are swing traders and you're looking for something. But to be honest, you know, I see breakouts occurring. If you still want to try and play them, you could do breakdowns. You watch our last few videos because we go over this constantly on what we're looking for. And if you're more of a fundamental investor, more deep value, I hope this one was useful to you. It's been a while since we really delved into some of this stuff.
Yeah, for sure.
If you have any questions on what any of these things mean, you know, I could go through and show you. I can click on these things and go through and show you what my calculations are. Obviously, you have to be able to see my 1 year data, which if you go over here, you can see where these things are and how I calculate these. It's complicated, but it works.
I have to say, when I built it, the most complicated thing was definitely the calculator, and the next most complicated thing was the conditional formatting.
Oh God, conditional formatting.
Yeah, because there was no. I don't remember where I posted it, but there is a video in one of the Roaring Kitty streams where he actually shows how he initially had conditional formatting set up. So there is. I posted a link to it somewhere, but there is some ways to figure it out. But you have to calculate like a lot of averages and standard deviations and stuff like that.
Yeah.
It's just based on all those things. So
yeah,
but those were definitely the most hard ones.
Same thing I found with the deleveraging calculator. It's like I just need it to work good enough. I just need to give it like ballpark figures.
Yeah.
Same with conditional formatting. I was going to try and go through and match exactly what RK did. And I found out like it doesn't matter. Like all I need to know is like this is the best year and now we're currently in a bad year. You know, and the colors, I can quickly look at all this data. And if there's no color to this, it's so hard to look at this and appreciate anything. When you put the conditional formatting on, it just quickly shows you, and I can look at this real quick and be like, where I know where we're at with a company.
Yeah.
That's why the conditional formatting is so important.
Yeah. The entire idea of it is to catch your eye in terms of looking at trends and the direction it's going. And for this style, you actually want a little bit of red, right?
Yeah, usually you wanted stuff to look like shit. You want the chart to look terrible. Because, like, for instance, when you pull up a consolidated balance sheet, now imagine this was 10 years long and all the numbers were just looking like this. It's so hard to look at that and appreciate what's going on.
Yeah.
You know, I mean, just putting some color to it just helps you know where we're at. You can look at the charts and stuff like that too, but there's still just a lot to it.
Hey Dane, before you go, pull up PRCH, PRCH.
In here or?
Yeah, in the charts.
Oh, in charts.
I was just I'm a bit impressed by that stock and keeping an eye on it because in this environment it keeps performing.
Hang on, I just gotta pull up a new tab here. Yeah, PRCH has been a strong name.
Yeah. And it's setting up maybe for a breakout, but how do you look at just before we leave, how do you look at this in even if it's a strong stock in this environment?
I mean, it looks good, and the 20 and the 10-day are right there, and it's riding the 5-day moving average.
Yeah.
We're in a kind of well, a sideways period, I would say, now in the market. So yeah, this could break out.
Yeah. It's on the watch list.
Yeah, and I mean, it's just shown strength. This was $1.40 back in October.
Yeah, I know.
So
It had a pretty long consolidation phase, even a drop before the earnings there that made it bounce up again.
yeah, I mean, this is a good EP to play right here.
Yeah. So now we can just say that we went through one ticker at least.
Yeah, well, no, we touched on a few, but
Yeah.
That's why I said, especially in these down periods like this, where there's not much point in going through breakouts because there's very few, and like I said, it's all about statistically finding breakouts that work. If in a given week, let's say there's 30 breakouts and 25 of them work out, that is a great time to be in breakouts. If there's 10 breakouts in a week and 2 of them work, that's a terrible time to be in breakouts. So it's why even if there is charts and stuff working, it's tough to say that like it's really worth your while going through. I'm not saying you can't do it. It's a lot of work though, and the odds are against you. That's all I'm saying.
Yeah. Yeah.
So I'm just pausing right now, just kind of waiting for some stronger signals that things are looking better.
Yeah. Same here.
All right. Yeah, I do got to get going though. So thanks for everybody that tuned in. I hope that was helpful. Anybody who has any questions, please let me know. Be happy to go over stuff.
Yeah, and join the Discord. We have some new people there, so hopefully we can, how do you say it? Like grow the community in there too.
Yeah, as always. And the Discord's, something I check during the week. The stream,
Yeah.
I can go on YouTube and check the comments, but it's just not as quick as like a Discord where I can kind of chat with you.
Yeah.
All right.
And link should be working now, so.
Yeah. We didn't even go over the initial ticker there.
Which one was that?
Bond. No, I'm saying bond.
Bond.
Well,
Yeah.
What kind of herbs do you know all about, Johnny?
All of them.
Anyways,
we-
what was it you said? We almost picked CAUD for the video, and we realized we'd already done CAUD, and it's dying even more. So
yeah, I saw the market cap is 0 now, so.
solid.
Yeah.
That one, if I pull up in the deleveraging calculator, will not look good.
No, that will not look good. And
Now I'm just
saw
curious.
some comments. People were pretty frustrated about the management there and the board.
Let's see what kind of fancy numbers we get here.
It might cause an error to your sheet, this one.
Sometimes the numbers don't fit in the columns. Usually it's like if I pull up Apple will not fit because it's just such a big company. All the numbers are like not meant to be in trillions and billions.
Yeah.
And like you can see, it loads pretty quick. Yeah, they just need to offer 2 billion shares, 2.4 billion shares to make it.
Yeah.
So they're close.
A bit more than what BNet did, so it's gonna be fine.
The sad part is that's 2.4 billion shares at a penny. So I stand by the calculator working.
Yeah. Yeah, see the market cap 0.
Yeah. Yeah, this is one that when you scroll through you can just pass. It's not gonna make it.
Yeah, for sure.
All right, well with that, hope everybody enjoys the rest of your weekend, and we'll be back on next weekend, and hopefully we'll start to see some positive signals in the market next week.
Yeah, hopefully.
All right.
See
Peace
ya.
out, everybody.